Good morning, students. Today we are going to discuss about our next topic, the real economy and the financial economy. The first topic, what is the real economy? Real economy is the part of a country's economy that produces goods and services rather than the part that consists of financial service such as banks, stocks, markets, etc. The real economy concerns the production, purchase, and flow of goods and the services like oil, bread, and labor within an economy. In the real economy, spending are considered to be real as money is used to effect non-national transactions. For example, wages paid to employees to enact labor, bills paid for provision of fuel, or food purchased for consumption. The transaction includes the deliverance of something other than money or a financial asset. In this way, the real economy is focused on the activities that allow human beings to directly satisfy their needs and desires apart from any speculative considerations. And the Islamic perspective of real economy. In Islamic finance, it claims to be real economy oriented, as all transactions must be asset linked or asset backed or asset based. Appropriate conceptualization of the real economy can help the industry to be relevant and effective for broader socio-economic transformation. It is important to note that, firstly, the sustainable development nature of Islamic finance offers benefits for economic growth, reducing poverty and fostering sharing prosperity. In addition, Islamic finance can significantly contribute to economic development, given its direct link to physical assets and the real economy. Secondly, greater emphasis on profit and loss sharing encourages the provision of financial support to productive enterprises that can increase output and generate jobs. The emphasis on tangible assets ensure that the industry supports only transactions that serve a real purpose, thus discouraging the financial speculation. Thirdly, the redistribution of wealth and the opportunity in Islamic finance helps to promote financial sector development and broadens financial inclusion. This is because through the redistribution of wealth and the opportunity, Islamic finance could help improve financial access and foster the inclusion of those deprived of financial services. Finally, the risk sharing modes of financing could be useful in improving access to finance for the poor and the small business. Overall, these key principles of Islamic finance can help to create a better understanding of this positive role that Islamic finance can play promoting real economic development. And the next one is, what is financial economy? The financial economics is a branch of economics that analyzes the use and the distribution of resources in market in which the decisions are made under uncertainty. The financial decisions must often take into account future events, whether those be related to individual stocks, portfolios, or other market as a whole. Financial economics analyzes the use and the distribution of resources in markets in which decisions are made under uncertainty. It employs economic theory to evaluate how time, risk, opportunity cost, and information can create incentives or the disincentives for a particular decision. Financial economics often involves the creation of sophisticated models to test the variable affecting a particular decision. In addition, financial economics is one of the many branches of economics that deals with the various financial markets, taking into consideration how resources are being used. Its particular attention to monetary activities sets it apart from the other branches. In financial economics, important aspects that occur in forex and stock markets are analyzed, as well as how inflation, depression, deflation, recession, prices, and more impact on one another. Financial economics is important in making investment decisions, identifying risk, and valuing and securities and assets. Financial economics also studies the risks and identify ways to minimize the investment related risk. Financial economics also encompasses financial instruments such as bonds, stocks, and securities. This also look at the various market regulations that govern the markets where these tools are traded. Of course, the market and the financial institution are also within the purview of financial economics. And the Islamic perspective tells that the organizing principle of Islamic finance is an Islamic economy is transaction based on exchange, where real asset is exchanged for real asset. By focusing on trade and exchange in commodities and assets, Islam encourages risk sharing, which promotes social solidarity. Islamic finance is based on a simple rule, which is to avoid trading presents for future money at a premium. This effectively eliminates the finance through debt, although it does not exclude providing interest-free loans for charitable purpose. Finance is provided through equity participation or profit and loss sharing, which is called PLS, profit loss sharing, in return for equity or right to share in pre-agreed proportion of profits. It is also provided through the sale and the lease of assets in return for commitment to repay their value or their usufruct at a later date. It is further provided against a commitment to deliver a manufactured commodities. And the conventional finance is almost void of risk sharing. On the resource mobilization side, fund owners provide their financial resource on the basis of the classical loan contract. Accordingly, banks taking deposits would guarantee both principal and interest on their customers' deposits. On the resource use side, banks take risk only on collateral and not on entrepreneurial activities. The use of collateral enables banks to limit the monitoring of their borrowers without increasing default risk. Thank you. These are about the real economy and the financial economy. The real economy is mostly deal with like Islamic economies, but the financial economy is consisting higher uncertainty and higher risk in the business. Thank you, students.